Have you ever thought to yourself, I wish I could find a strategy that's already been proven to work and has made millions of dollars to somebody out there, so that I too can use it and become as profitable as they are? Well, what if I told you that there is a millionaire trader that revealed his exact trading strategy that grew his trading account from just $9,100 all the way to $82 million in a span of just 8 years? Instead of just using random strategies all over the internet, why not learn and use the exact same strategy that's already been proven to work by somebody else? Well, in this video, I'm going to show you exactly one of those trading strategies. Let's get into it now. You may be asking yourself, but who is this millionaire trader anyway? What is his strategy? Well, ladies and gentlemen, meet Christian Kalamagi. This guy's trading account in 2013 had only $9,100, and by 2021 his trading account had grown all the way to $82 million. Of course, the journey for him wasn't always all sunshine and rainbows like you and me and most traders out there. Christian blew his trading account 4 times during the first 2 years of his trading career. He later on discovered his breakout strategy and a good risk management system that allowed him to make the tens of millions of dollars over the coming years. His risk management system is as simple as this. First, never hold more than 30% of a position overnight. Second, all positions should fall between 10 to 25% of the account size. Third, the risk per position should be between 0.25% to 1%, although he did say that when his trading account was much smaller, the risk per position was between 0.5% to 1.5%. The breakout strategy that he uses to trade is actually a swing trading strategy that works perfectly on the daily time frame. The basic idea is that stocks tend to move in stair steps. According to Christian, stocks tend to make a 20 to 50 move in one direction, then pull back and go sideways for a while before making another move. In fact, he says that he himself usually looks for moves of between 30 to 100% lasting between 1 and 3 months. Here's the chart of MSFT, which is the ticker symbol for Microsoft. I am on a daily time frame, and we're going to add some moving averages to the charts. To do that, go to the Indicators tab on TradingView and type in moving average exponential, then click on this one 3 times because we're going to need 3 of them. Now we're going to access each of these indicator settings in order to change it up a bit. For the first one, click here and on the Inputs tab, change the length to 10. After that, head over to the Style tab and change the color to this light blue, and then click OK. We're going to do the same for the second EMA. On the Inputs tab, change the length to 20. Then head over to the Style tab and change the color to this light green, and then click here to increase the thickness a little bit. After that, click OK. Lastly, for the third one, the length is going to be 50. And the color is going to be this green right here. We're going to click here to make it even thicker and then click OK. We're going to be using these indicators to validate consolidations in the market. When a price is bouncing up and down between the EMAs like this, that would basically mean that the market is consolidating or moving sideways. As simple as that. Now let's go over the conditions for entering trades with this strategy. According to Christian, the first thing that he usually looks for is a big bullish move of between 30 to 100, ideally lasting between 1 and 3 months. The second condition is for the price to pull back into consolidation or a sideways movement. This consolidation phase can last between 2 weeks and 2 months. During this consolidation phase, the price should find support between one of the 3 moving averages, like it did right here. Lastly, he would wait for the price to start breaking out of the consolidation phase and enter a long trade immediately. In this particular example, this is where we would enter a long trade. Stop loss is going to be placed at the low of the day, which is this one right here. Christian also takes the range of price movements into consideration to ensure an overall sensible risk to reward ratio. For example, if a stock price has an average true range of 3%, then the stop loss should never be greater than 3%. As far as risk management goes, Christian says that he usually sells a third or half of his positions 3 to 5 days after entering the trade. He then moves the stop loss to break even, and as the price continues to move forward, the stop loss is trailed according to the 10 or 20 day moving average depending on price volatility. In this particular example, we're gonna trail it according to the 20-day moving average, meaning that if the price ever closes below the 20-day moving average, we're gonna sell the rest of the positions. So as you can see here, we would have sold half of the positions after 5 days, which is at the close of this candle, where right here the risk to reward ratio would have been 1 to 1.33 and the profit made would have been half of 7.37%. Then here you can see that the price closed below the 20-day EMA. This is where we're going to sell the rest of the positions. The respiratory word ratio would have been 1 to 5.67 and the profit made would have been half of this. Now here's another example. This is the daily chart of Axon, which is the ticker symbol for Axon Enterprise. First, the price did a big bullish move of 78, which is actually between the 30 to 100% recommended by Christian. We also see that this bullish move lasted exactly 36 days, which also is between the 1 to 3 months that's recommended. Second, we see that the price pulled back into a consolidation that lasted exactly 28 days, which again is between the recommended 2 weeks to 2 months. We also see that during this consolidation phase, the price found support at the 20-day moving average. We're gonna enter a long trade as soon as the price started breaking out of the consolidation phase. Right here the stop loss is going to be set at the low of this daily candle right here, and we're gonna sell half of all our positions after 5 days, which is at the close of this candle right here. The risk to reward ratio would have been 1 to 4.62 and the profit made would have been half of this. Then here you can see that the price closed below the 20-day EMA, so this is where we're gonna sell the rest of the positions. The risk to reward ratio would have been 1 to 8.87 and the profit made would have been half of this. This strategy is stupidly simple, so much so that even your dog can actually do it, but the reason why Christian is so successful with it is the philosophy of low risk versus high reward. Christian says it's all about making 5 to 20 plus times your initial risk. You can be widely profitable with having just a 25 to 30 win rate. It's all about having small losses and big winners. Of course, there is always an aspect of subjectivity when it comes to non-indicator based strategies like this one, but just like any other skill set, you will get better with time. That is, if you're planning on using this strategy. If you like this video, please hit the like button below and consider subscribing. Thanks for watching, and I'll see you guys next time. Foreign.